Welcome to this explainer, where we're digging into a company called DigitalBridge. Now, these guys are right in the middle of the whole AI revolution, which sounds great. The only catch? Their financial reports are, well, they're so confusing it's almost unbelievable. So, the question is this an AI powerhouse hiding in plain sight, or just a company with really messy books? Let's find out.
All right, let's just jump right into the big puzzle. How on earth can a company's revenue fall by more than 100% in a single year? I mean, that shouldn't even be possible, right? It feels like it breaks the laws of mathematics. You can't lose more than everything you started with. Or can you? Well, this is the exact mystery we need to solve with DigitalBridge.
And here are the numbers in black and white. It's not a hypothetical. Take a look. In one quarter, DigitalBridge pulls in nearly $400 million in revenue. Pretty solid. Fast forward 1 year to the same quarter, and they report negative $3.2 million. That's not a drop, that's a fall off a cliff. For pretty much any investor out there, seeing a number like this is a giant, flashing red light. So, what is going on? To really get DigitalBridge, the source material says you have to learn to do one thing. You've got to separate what it calls the signal from all the noise. Somewhere, buried under these insane-looking numbers, there's a real business. We just have to find it. So, what is all this noise? Well, it pretty much all comes down to this one little accounting term, carried interest. The easiest way to think about it is like a potential future bonus. It's a percentage of profits the company hopes to earn from its investments down the road. But see, it's not cash. It's not real money in the bank. It's just an estimate on paper, and that estimate swings wildly up and down every single quarter. And this is exactly how they pulled off that negative revenue trick. In that one quarter, the value of that future bonus got marked down by a lot, a negative $115 million to be exact. That one non-cash, on-paper adjustment was so huge that it completely erased all the real revenue that actually brought in. It's really important to get this. It's purely an accounting thing, not a real-world cash loss. Okay, so enough about the confusing noise. Let's flip over to the other side of this and focus on the signal. This is the core underlying business that's making actual money, but it's getting totally drowned out. According to the report, this is where the real story is.
And you can hear it from the CEO, Mark Gonzi. He's basically trying to tell everyone, hey, stop looking at all that accounting weirdness. Look over here. He wants investors to see the simple, straightforward story of a solid asset management business that's growing just like they said it would.
And this table just lays it all out perfectly. You've got two totally different stories here. Down at the bottom, that's the noise, the crazy negative carried interest number that wrecked the headline. But now, look at the top. That's the signal. Fee revenue, the actual cash they collect from managing things, is up a healthy 8.5%. And even better, fee-related earnings, the profit from those fees, is up an incredible 23%. That is a strong, growing business. So if you're going to focus on one number, this is it, that 23.1% growth. Forget the headline revenue, it's just a distraction. The report argues that this number, the growth in fee-related earnings, is the single best way to check the pulse of the company. It's real profit. And it's growing fast. That's the signal you're looking for. Okay, so now we get it. There's a solid, growing business hidden in there. But here's where it gets really interesting. Let's connect that signal to what is arguably the biggest economic story on the planet right now, artificial intelligence. You see, the report's argument is that DigitalBridge isn't just some company that might benefit from AI. No, they're a pure play on the actual physical stuff that makes AI possible. They're not making the fancy chips. They're providing the picks and shovels for the gold rush, the giant data centers, the fiber optic networks, and crucially, the massive amounts of power needed to make it all run. And the amount of money pouring into this is just mind-boggling. The hyperscalers, your Googles, your Amazons, your Microsofts, are spending hundreds of billions of dollars building out their AI capabilities. And where does all that money go? A huge piece of it goes directly into the pockets of the companies that build and own the infrastructure, which are the very companies DigitalBridge invests in. And they are absolutely ready for this tidal wave of cash. Get this, they've already locked down 21 gigawatts of power, which is the #1 thing holding back AI development right now. They've got a pipeline to build tons more data centers, and they're even building these huge, sprawling AI campuses. They are literally building the factories of the future. So let's put it all together. We've decoded the crazy accounting. We've seen the direct line to the AI boom. What does it all mean if you're looking at this as an investment? Let's break down the final bull case versus the bear case. The argument for DigitalBridge, the bull case, is pretty simple. They are perfectly positioned for the AI boom, and their core business is on sale because of all the confusion. The case against them, the bear case, is that this accounting mess might just keep scaring people off forever. And, like any big infrastructure player, they're sensitive to things like interest rates. So what could actually change the narrative for good? Well, the report says to keep an eye on a few things. In the short term, just keep watching that core earnings number to make sure it stays strong. But the real game changer, the big one, asset sales. The moment they start selling some of these investments and turn that noisy, on-paper value into billions of dollars of cold, hard cash, that's when the market might finally have to pay attention. And that brings us to the report's final verdict, which is definitely bullish. The thinking is that the market is so fixated on the accounting noise that it's giving investors a rare chance. You get to buy the stable, fee-generating business at a reasonable price, and you basically get a free lottery ticket on the massive AI upside. So, we're left with this question. The report says the market is just seeing noise. But now that we've pulled back the curtain and decoded what's really going on, do you see the signal? Is this a compelling way to invest in the very foundation of the AI revolution? Or is the complexity just too much to handle? That's the multi-billion-dollar question.